Hello and welcome to the Morningstar series Market Reaction. I'm Emma Wall and I'm joined today by Charles McKenzie, Chief Investment Officer for Fixed Income for Fidelity. Hello, Charles.
Hello.
So a week after the shock election of Donald Trump as the next President of the United States, prior to this result, we were very much expecting the Fed to raise rates in its meeting in December. Do you think this will still go ahead?
Well, no, I do. I think it will certainly go ahead in December. In fact, the markets are almost giving it 100% probability that the Fed is going to raise interest rates in December. So I don't think that's changed anything at all.
And looking to what we were expecting from 2016, the Fed indicated there would be 4 rate rises. We haven't got that. What should we expect in 2017, in particular because a lot of the policies that Trump has spoken about are inflationary?
Yes, and I think the markets are trying to work out exactly what the Trump victory means for the US Treasury market. Clearly, at the moment, there's an awful lot of concerns about reflating the US economy and how inflation might feed through into the US system. And of course, a much greater, perhaps, fiscal spending, a greater supply of government bonds coming to the market, meaning there has basically been a bear steepening of the market, i.e. that longer dated US Treasury bonds have been underperforming. Now, what does that mean? Well, actually, the Fed are probably likely to raise interest rates going into 2017. And we're expecting probably about 2 rate hikes going into next year.
Of course, we don't have to wait for a rate hike to see a change in bond prices. This is a market at the moment that is so much about sentiment in both the fixed income world and indeed equities. And we have seen bond prices reflect those rate rises to come, haven't we? Which is causing some people to say, this is it, finally, the bond bubble is bursting.
Yes, and you're right, and the markets have reacted very aggressively in terms of that. But we also have to step back a little bit. We're right now in the middle of what feels like a storm. And US Treasury bond prices have sold off, but yields still are lower today than they were at the beginning of the year, which is, so I think we just need to take some sort of perspective on this. I think we also have to be aware there are still significant structural headwinds to global economic growth. We have a huge amount of debt in the global economic system, so it's going to be quite hard for global economic growth really to power through. And we are really talking about the US economy here. If we start expanding our horizons into Europe, into Japan, into emerging markets, the headwinds to growth are quite significant. So it's really only the Fed who are likely to be in play in terms of raising interest rates. Other central banks are still on the mantra of keeping rates low and very much looking for quantitative easing. So I certainly think it's very premature to call the end of a bond market rally, because there's an awful lot of structural headwinds in other parts of the world which will keep yields relatively low.
Of course, that means that if the US does raise rates and indeed other parts of the world keep this very low rate environment, we will see a disconnect where at the moment, over the last couple of years, developed markets have sort of been moving together. What does this mean for investors of bonds to suddenly have this two-way market?
An opportunity. Actually, I think it does give a great opportunity, because bond markets can only dislocate so far. There is always going to be a link between different bond prices. But what I think it certainly gives bond investors are opportunities. Greater volatility gives greater opportunities. So people can certainly look for opportunities in, for example, regional differences, but also in inflation-linked bonds compared to nominal bonds. Within the credit markets, there's clearly all sorts of changes in regulation, which is going to affect perhaps the financial sector. That will undoubtedly throw up opportunities for bond investors in the months and years ahead.
Charles, thank you very much.
Thank you.
This is Emma Wall from Morningstar. Thank you for watching.